Hey guys, what's up? If you ever wondered what the level 2 is, or the time and sales is, or what a trader means when they said they looked at the time and sales in the level 2 to predict a price breakout, and why traders always say it's super important to read the tape, I'm going to explain what all that means, how you could use all of it to your advantage, and then we're going to dive into a real stock and real price action to kind of walk you through an example. If you're new to the channel, my name is Ethan Chase and I post videos every single day on personal finance, investing, and life. There's really two components to this video, and the first is the level 2, which you can see on the right, and the second is the time and sales, which you can also see on the right. And the takeaway is the level 2 and the time and sales are very much interconnected, as you'll see later in this video, and they determine pretty much all the price action and what is shown on the chart of stock. To kind of take a step back, I know I always learn best through examples. So we're going to take the example of this pen, and we're going to create a marketplace for this pen, and we'll kind of create a level 2 and a time and sales for the pen so you can understand kind of what's happening when it's applied to a stock. The first thing first is we're going to build the level 2, and there's two components of the level 2, and this is irregardless of whatever brokerage you have or trading software you use, but there's essentially the bid and the ask. So the question is, what's the bid, what's the ask? Well, the bid is really the buyers. It's how much the buyers are willing to pay. And the ask is the same thing for the sellers. It's how much a seller is willing to sell, their stock for, or whatever the marketplace is. If it's for t-shirts, how much they're willing to sell their t-shirts for, etc. But let's take the example of the pen. And let's say, assume there's a marketplace for the pen. And let's say you don't have a pen, but you really like a pen, and you like this pen specifically, and you want to purchase it for $5. So what you're going to do is you're going to go and participate in the marketplace. So that would mean, logging on to Robinhood or TD Ameritrade or what have you, and you want to place an order, a request to purchase a pen. So what you're doing is you're making a bid to buy the pen at, let's say $5. So, if you place an order on a platform, maybe it's Facebook Marketplace if it's a pen, or if it's a stock, a brokerage firm, but essentially you're placing a bid and you're placing an order for $5. And there's a second number that pops up, and it's a quantity number. So let's go to the actual example. If you see on here, this is a stock price. So you have all the stock prices, but if you're looking at the left side, you see 175.26. You also see the number 1. What that represents is that someone or a group of people are offering to purchase a stock at that price, and the quantity, the amount of shares that are being bid at, is 100. So each number is, you have to do it with a multiple of 100, but that represents the quantity. So going back to our pen example, if you are one person and you want to buy this pen for $5, the number 1 would pop up. Now with stocks, it's a multiple of 100, but let's say you tell your friend about it and they want to purchase the same pen. Obviously, it would be kind of rude of them to bid $5.01 because then they would get the pen first, and you told them about the pen, so you should get it first. What they can do is they could also hop on the same price, hop on the bid as well, and then they could also offer $5. So now if your friend offers $5, now there's 2 people offering $5 for this pen. That's why the number went up to 2. So if you go back to the stock example, you see there's various numbers. At the bottom, on the left side, you see NSXX, 175, 10, 45. That means, 45 times 100, 4,500 shares are being offered to be purchased at that price. So that's you. You are the buyer. Now, in order to have a marketplace, you need both sides. You need buyers and sellers. And this is where supply and demand comes in as well. The buyers is also the demand, where the sellers are the supply. Okay, so now let's say you offer $5, but let's say someone else around the world, or maybe in your neighborhood, they have this pen, or maybe it's me, I have the pen, and I want to sell it for $6. So if I make an offer, if I make my ask price $6, then on the level 2, on the right side, you'll see 6, and of course a quantity of 1. So let's go back to the stock. In the picture, on the right side, that's the sellers, that's the supply. You see 175.38 and a quantity of 2. So that's how the level 2 works. It's basically the second level of depth of what's going on behind the scenes of what's determining the stock price. And, this is what will determine what you see on the chart, and we'll get to that later. But if you have any questions, just comment them down below and I'll answer them once the video is posted. I'll make sure to get to all of them. So no question is too stupid or too silly. Ask away and I'll do my best to answer them. Okay, so let's get back to the example of the pen. You have two people wanting to buy the pen at $5 and you have one seller willing to sell it at $6. So the question is now, what happens? Obviously you want the pen to exchange hand, and that would represent volume or volatility. So how do who conducts the trade? And that's where market makers and brokers step in. But what happens is, and this is where you could start to use the level 2 to predict kind of price movement, is you want to look at really the price, but also you want to look at the quantity, which is super important. So you have two people at 5 and you have one person at 6. And now so now you kind of have a sense of where the demand and supply is. And you know that demand is greater than supply, essentially. I mean, there's going to be some variations, but because you have two people versus one person, you kind of have a greater demand. And this plays out in the fact that in order for the trade to happen, you got to ask yourself, okay, what's the pen going to be traded at? Is it going to be sold at $6? Is it going to be sold at $5, $5.75, $5.25, $5.50? And that's kind of where the match happens. And because you have, multiple buyers, so let's say instead of 2 people, let's say this was like 15, right? For a kind of dramatic example, let's say there's only one person with the pen, or really one person at $6, but the next bid is $5 and there's 15. So now we know for sure that demand outweighs supply. No question about it. Okay. So what would happen is once the price of the stock, or once the pen is sold, then this is where the time and sales comes in. So if you take a look at the time and sales on the right, you have a couple components. You have the time, so that's the time at which the trade was transacted in real time. You have the price, so the price at which the shares were traded at, and then you have the quantity, again, in multiples of 100. So it's really 200 shares times 100 because it's multiples of 100. So going back to the example, when the trades actually occurs and a transaction is transacted, there's questions of where, what price was it actually sold at? Is it 5? Is it 6? Is it somewhere in between? And given this, what would actually happen is that, the price would actually have to go more towards the buyers because there's more of them. So you would see, maybe the pen sold at, I don't know, 575, 585, something like that. Of course, these are all just hypothetical numbers, but that's pretty much what's going to happen. Now, there's various scenarios of this. Technically, one person could just buy on the ask and buy it for $6 because they want to secure it, but for, explanation purposes, let's just assume this happens. So let's say the final kind of selling price is $5.75. So one pen was sold at $5.75 to one of the bidders here. And in order for the purchase to actually happen, the bidders have to kind of step up and the seller has to come down. But let's say the pen was sold at $5.75. On the time and sales, what would happen is you would see, this is called the tape, and the transaction would be printed. So you would say, let's say this transaction occurred at 3:30 Eastern. So 3:30 p.m., 30 minutes before the market closes in the afternoon. Okay, 3:30 p.m. Eastern. So on the time and sales, you would see 3:30 p.m. You would see the price of $5.75, and then you would see the quantity or the size, which would be 1 because it was one pen. Now, there's a little bit more dimensions to the time and sales, and it's going to depend on by broker and by platform, but you have it kind of color coded, and you have a green, a neutral, and a red, and this just represents further indications of who's in control, the buyers or the sellers. So if you have more buyers, essentially, which is what we have in this example, because there's 15 compared to 1, what you would see happening is that because the buyers are in control, they have the power the people who are selling their pens, they can't sell it for $6 because no one's going to take it. So what they have to do is reduce their price and come down to maybe $5.75. And because the sellers are coming down, that represents that the buyers are in control, so there's strength and that the price might go up in the future. If that happens, you see it as green. That means buyers are in control, they have the strength. If it's neutral, that means that there's equal kind of supply demand. There's 15 buyers of a pen, 15 sellers of a pen, so they would meet right in the middle at 550. And this brings up a good point, because if you hear traders talking about spreads, how the spreads were too high, it's important to know what the spread is. So again, you have your bid and you have your ask. So let's say you have a 5 and you have 6. Your spread is just really equal to the difference between the bid and the ask, and that's going to be really, if you do it, mathematically, the bid minus the ask, which is equal to $1. So that's the spread. And if you take a look at the price of the stock, it's anywhere between $5 and $6, and to have a spread of $1, that's insane. So right off the bat, if you want to enter the trade in immediately, you're already pretty much down $1. If if you're buying, you want to buy on ask. If you're selling, you want to sell on the bid, and immediately you're already down $1. That's why traders say they sometimes don't enter trades if the spread is too large, because once they enter, they're already down a certain amount. And if you look at the equation, bid minus ask, ask minus bid, it doesn't really matter. It's the magnitude of the difference. There's no direction of the number. It's just the hard magnitude of the number. So it's always positive. There's never really a negative spread. At least I've never heard of that. Okay. Now, going back to kind of the example of the time and sales, when it's green, that means sellers came down. When it's neutral, so let's say, now we know the spread is 1, right? It's the difference between 6 and 5. So, spread is 1. If, no one really wanted to hop in immediately, but they just wanted to meet it in the middle, the transaction would kind of be printed at $5.50. That's, the middle price. That's the average. So what you see is, because there's it's kind of equal, that's where you see the neutral color. On the flip side, when you see the red here, that's an indication of there's a bunch of sellers in control, that there's more supply than there is demand. And what that means is that if you want to, if you own the pen and you want to sell at $6 and there's many more sellers than there is buyers, there's no need for you to drop your price of the pen. You might as well stay firm at your $6 mark. And if someone wants to buy the pen off you, they have to come up and increase the amount they're willing to give you and meet you at $6. So when you see a red price, that means there's actually more supply than demand, more sellers than buyers. The sellers are in control. So that's pretty much it of how the level 2 and the time and sales work. So to recap, and again, if you have any questions, comment them down below. I will answer them. You have on the left of the level 2, you have the buyers. On the right, you have the sellers. The buyers are the demand, the sellers are the supply. And you have the price at which everyone is bidding at, either willing to purchase it at or willing to sell it at. Then you have the quantity of shares, and again, they're multiples of 100. So really 1 represents 100. And just a quick note, you see these kind of weird letters, New York Stock Exchange, EDGA, ARCA. Those are just exchanges, which is where the trades actually get routed through and transacted. That's not a big importance right now, but in case you want to know, that's also a component. So the level 2 is kind of the layout, the kind of more detailed analysis of where everyone stands. And then once the transaction actually occurs, then that transaction is printed and recorded on this kind of ever-flowing time and sales. And so that's how they're related, right? The level 2 is the data and kind of the market making potential, and the time and sales is the actual market making and a recorded history of that market making. Now, there's a few ways of how you could kind of use the level 2 and the time and sales to kind of predict price action, and we're going to hop into that right now. The main thing you want to focus on if you're trading penny stocks, or if you're trading, we get started with penny stocks. If you're trading penny stocks or low cap stocks, an indication of a halt is when the bid or the buyer side, they kind of get pinned at a certain number, and you'll see quantities going up and up and up. You can look up videos of stocks getting halted, but what essentially you'll see is pretty much the bid will get pinned, and it's typically a higher price than the ask. So we can draw it out real quick. And these are just hypothetical numbers, but let's say you have a stock, I don't know, 590, okay, and there's like, let's say, so the number, let's say, I don't know, like 1,000 people, really 1,000 times 100 shares, and then you have, I don't know, 585, like 5. So obviously this doesn't make sense in kind of market economics. You wouldn't have a bid higher than ask, and especially with 1,000 times 100 compared to 500. But this is technically a good indicator that stock is going to get halted, and you'll see the bid and the ask kind of just freeze, and that's what it means when it's getting pinned down to it. You'll see this number won't really move, and it'll just keep getting stacked, and once you see it, it'll be much more easy you'll have an intuition for it. But that's a good indication of when a stock is going to get halted, moving up. And on the reverse side, if the same thing happens on the ask, that means the stock is probably going to get halted, coming down. The next thing you want to look for is just general price quantities. So usually, whole number, $half, represent, like, those price levels represent massive resistance lines or support lines. So let's say a stock just hit 1550. So let's say you have 15, let's say 49 on the 48 on the bid, and so you have 2, and then you have 1550, a very critical number, and you have, let's say, 80. Okay, so what we see here is obviously supply is greater than demand, right? You have, let's draw that out. You have 80, 800 shares versus 200 shares, or 8,000 shares versus 200 shares. And what this represents and what you hear traders say is that there's a massive wall. There's this massive kind of brick wall at 1550. And what they mean is that there's this a massive order ready to go at 1550. And in order for the stock price to move higher than that, it has to kind of break through that wall, it has to push through that wall. So that's why when you have kind of a large, and of course this could be across multiple exchanges, right? You could have on a different kind of exchange, you could have the same thing at 20 shares, right? So you have this massive wall that the stock has to, break through in order to move higher. So what you can do to see if it's going to break that is, and sometimes more as it goes on, more sellers will step up or more buyers will step up, etc. But it's really cool because you can see live in real time the kind of tug of war between the buyers and the sellers. So let's say 50 and you have 20 more. Okay. So what you could kind of look at to see if it's going to break 1550 and break out above that is you want to see the number of, the quantity at 1550 get chipped away, and you'll see it real time. It gets slowly and slowly reduced. That's the buyers slowly chipping away at it. And once it finally breaks 1550, it should pop to maybe 1560, 1570, depending on how fast the stock moves. But that's also how you can use the level 2 and the time and sales to your advantage, is to see where there are walls in the price and when those walls are going to break. And when they break, that's what leads to kind of the big price breakouts and explosions that you like to see if you're trading momentum or volatility. The next thing you can look for is kind of the speed at which the time and sales are showed and the transactions are printed. Let's say, going up to 1550, 1548, 1549, a few at 1550, it's kind of slow. But right once 1550 breaks, or right before it, you'll see the time and sales start printing much faster. The numbers will just start coming and coming, and that means there's more volume being traded. Other stock traders are watching the same thing you're watching, and other people know that there's a wall at 1550, and once it breaks, it should go higher. So once you see the speed at which the numbers are being printed, that gives you a good indication that other traders are watching what you're watching, and that there's volatility, volume, and price action to come in the stock. With all that said, let's jump into a real stock to give you a good example of how the time sales and the level 2 works in real action.